Today, we are diving deep into the wild world of investing. But here's the twist. We're not going to be staring at charts and numbers. We're going to be looking in the mirror. Because with some amazing insights from market expert Dr. Hisham Hassan, we're about to find out why the biggest risk to your money is probably your own brain.
So let's just start with the one question that drives every investor crazy, right? You see all the experts, you see the analysis. The data is literally available to everyone with an internet connection. So why then do so many people still end up losing money? The market isn't some hidden secret. So what is? So here's the roadmap for this explainer. We're going to start with what we're calling the billionaire's question. Then we'll pinpoint the real enemy you're up against. After that, we'll learn how to actually read the market's mood. Here's some pretty intense stories from a major crash. And finally, wrap it all up with a simple rule that might just change everything. Okay, first up, the billionaire's question. This really gets to the core of the problem, because the big secret to investing isn't about having more information. No, that stuff's everywhere. The secret is hiding somewhere else entirely.
And this right here, this is the absolute key from Dr. Hassan. You, me, Warren Buffett, we all see the same charts and get the same news. The difference between winning and losing isn't what you know, it's what you do with what you know. It all comes down to how you react. Are you making moves based on a solid plan, or is it just pure emotion? So if the problem isn't the data, then what is it? Well, that brings us to the real battlefield here, your own mind. You know, the single biggest threat to your portfolio isn't some sudden market crash. It's the person staring back at you in the mirror. And these two emotions, fear and greed, they work together to create the perfect trap. You know, fear is that little voice whispering, hey, you've made a small profit. You better sell now before it's gone. So you do. And then you watch in agony as the stock triples. And then greed is on the other side, yelling, don't sell that loser, it's got to come back. So you hold on, hoping, while your investment just sinks lower and lower. It's like they're working together to wreck your account.
This quote from Dr. Hisham just nails it. The stock market isn't some cold, logical machine. It's just a giant reflection of millions of people all acting on these exact same feelings. And your mood, happy, sad, scared, greedy, that's what decides your next move. That's what's really driving the whole thing.
Okay, so if the market is just a big mess of human emotions, how on earth are you supposed to read that? Well, that brings us to our next section. We're going to talk about technical analysis, but maybe not in the way you've heard before. Forget seeing the future. Think of it as a tool for reading the room. So let's just forget all the complicated jargon for a minute. At its heart, technical analysis is really just about one thing, reading the crowd. It's about looking at a chart and figuring out the collective mood. Are people feeling optimistic? Are they pessimistic? Are they just confused? That's all it is. And really, it all boils down to three basic scenarios. Think of it like a vegetable stand. If way more people want to buy tomatoes than there are tomatoes to sell, what happens? The price goes up. That's an uptrend. If there are tons of sellers and not many buyers, the price drops. That's a downtrend. And if buyers and sellers are pretty much in balance, well, the price just kind of goes sideways. It's just supply and demand, but on a massive scale.
And this is where it gets really interesting. The market's mood changes how it reacts to news. Think about yourself. When you're having a great day, a little bad news just rolls right off your back, but good news feels amazing. The market is exactly the same. In a happy uptrend, it'll ignore bad news but go crazy for good news. But in a sad downtrend, it's the total opposite. Every little piece of bad news is a disaster, and any good news gets completely ignored.
All right, that's enough theory. Let's see what this looks like when the rubber really hits the road. We're about to dive into two powerful, real-life stories from the 2008 financial crisis that show exactly what happens when fear and greed take control.
So for our first story, picture this investor. It's 2006. He's done everything right. He's built a multi-million-dollar portfolio through smart, disciplined work. I mean, this guy was the poster child for success, at least for a little while.
Just look at how this played out. He starts off rational, disciplined. But then, as the market gets crazy in 2007, that euphoria gets to him. Greed takes over. He stops thinking the market is smart and starts thinking he's a genius. So he uses massive leverage, which is just a fancy way of saying he borrowed a ton of money to make even bigger bets. He thought he couldn't lose. Then 2008 hit. The market froze, he couldn't get out, and his so-called genius was exposed. He lost everything. And I mean everything. He ended up in debt.
Now for our second story, we've got a completely different character, a businessman named Haj Saeed. He was a great trader in his own world, but when he looked at the stock market, he didn't see a place to invest. He saw a casino. And his story followed this painfully predictable path. He made his first bet, got lucky, and made a huge 50% profit really fast. That early win was the worst thing that could have happened, because it convinced him he was brilliant. He started ignoring his friends who were warning him, and he just kept doubling down, pouring more and more money in. But it wasn't a real investment. It was a speculative bubble. And when that bubble popped and the stock was frozen, that was it. Game over. He lost it all.
So after hearing those horror stories, what's the lesson here? Well, that brings us to our final and by far most important section, the fisherman's rule. This is the real secret to long-term survival and success.
So let's just pause here for a second and really think about this. Who actually wins this game in the long run? Is it the person who has the flashiest profits during a good year? Or is it the person who's the best at not losing money when things go bad? Because the math here is brutal, and it doesn't lie. Look at this. If you lose 20% of your money, you don't need to make 20% back to get even. You need to make 25% back. The deeper the hole you dig, the harder it is to climb out. That's why avoiding those big losses is way more important than chasing those big gains.
And this all comes together in Dr. Hisham's brilliant analogy of the two fishermen. You've got the expert. He's patient, he just catches what he needs, he keeps an eye on this guy, and when he sees storm clouds gathering, he heads back to shore early. He protects his boat. Then you've got the novice. He's greedy. He wants to catch every single fish in the sea. He ignores the warnings, stays out too long, and ends up losing his entire boat in the storm.
And that's the whole point. This is the single biggest takeaway. The best investors, the ones who last, they aren't trying to maximize every last penny of profit. No, they are experts at managing risk. Their number one job is to protect the boat so they can come back and fish again tomorrow.
So that leaves us with one final question, and it's a big one. The next time you go to make a trade, you need to ask yourself, who is really in charge here? Are you managing your investments with a clear, calm strategy, or are your emotions managing you?